Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us this weekend. It all of a sudden is cold. How about fall coming back? Puts a little bit of a dent in my golf game, but I guess that's not the worst thing in the world, right? My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're independent. We are a registered investment advisory firm, SEC registered investment advisory firm, and fiduciary. I want to thank everybody for listening this weekend. If it's your first time, welcome. If you are a regular listener, welcome back. I'd love for you to reach out. We get a lot of that, especially now that we've been on the radio for so long. We hear a lot of people will say, we've been listening for years and we're now reaching out. And so when you're ready, we love it. So if you have any interest in learning more about what we're doing and our strategies, and as you know, our job is to first and foremost create a institutional level financial plan. We think that is obviously very critical. Our job is to craft strategies that can deliver positive returns in negative markets to a point which could become more and more appealing, especially given this market, which we'll go over a lot of things today. And our job is to really try to bring tax reduction strategies to the individual investor. And so I'm so glad people are listening to the radio and listening to the Bison 2 energy strategy, because those tax benefits are very, very significant. Last year, you were able to reduce your taxable income, active or passive, by up to almost $90,000. And so if you sold a business, sold a property, if you have concentrated stock, now is the time to listen. I can't tell you how many people we've talked with that have significant concentrated stock positions in the Mag 7 names, and they don't want to sell because of the capital gains. I get it. But if the markets go down, you may have wished that you would have sold. But even better, because we certainly don't know which way the market is going, if we can reduce those capital gains with a investment in Bison 2, the energy strategy, and allow you to, to diversify, that is a phenomenal, obviously, opportunity. Also, the Roth conversion story. We don't talk enough about that, so I'm going to try to touch on that every week as well. So 630-492-1912, 630-492-1912, as many of you know. We are headquartered in Oak Brook, so just off of 22nd Street, right across from the mall. If you know where the Fidelity building, Fidelity office is in Oak Brook, we are on the 5th floor, so Suite 530. Please just stop in. No appointment needed. Chances are we'll either be in a meeting or on a call, so if you're okay with waiting for a handful of minutes, we certainly would love to have a conversation with you. Such a challenge in this market. Obviously, we're starting to see cracks. And again, as you know, on the radio show, we're education driven. We're product or investment agnostic. That is a massive differentiator. Most radio shows are just packaged as financial planning companies, but they know they're going to sell you an annuity, and that annuity is going to pay a very, very hefty and nice commission. So we're going to definitely talk about inflation and what that means for those lifetime income annuities each show, because that is something that's not talked about a lot. And we're definitely going to be talking about that. But when we see, topics and, headlines that, are very concerning, there are things that, we have to start to talk about. And the whole purpose and genesis of the radio, when we started, was to be different. Well, how are you different? Well, we're just talking about investing. We're talking about strategies that we would sell to and include in our own portfolios, include in our family's portfolios. And there's a difference there. As many of you know, it's my belief that most advisors do not invest the way that they suggest that their clients invest simply because they want a cookie cutter balanced type portfolio because it's scalable. That means they can make more money. But when you hear, the governor of the Bank of England has said recently that the events that have transpired recently in the U.S. private credit markets have worrying echoes of the subprime crisis in 2008. So we don't need to get into what's going on, in the subprime private credit market, but it's certainly something that has all of a sudden popped up and has very, very significant, alarming kind of correlations. I would probably think would be the best word to 2008. It's certainly not. We're calling it to be a subprime crisis like what happened in 2008. But anytime you hear on Wall Street that it's different this time, generally it's not. And I think those are the four most expensive words in investing is it's different this time. The cause is generally different, but the underlying tenets of what, makes the market do what it's going to do, whether on the upside or downside, generally is, kind of similar, right? And so, the banknotes, as many of you know, we do, we'll probably end up the year at 75 to 80 million in new issuance. So the banknotes, it's relatively significant. The banknotes, we say banknotes, right? Because that's just the name and terminology that we have. Each bank has a different name for them, but they're very, the bottom line is this. We're still pricing notes, around 12.5% with 30% downside protection. And there is something comforting to the individual investor when they know that they have 30% downside protection of the indexes that note is tracking before they don't get paid a monthly interest payment. And so if you're looking to generate cash flow, I would compare this to an annuity. I mean, I don't think there's absolutely any comparison. The only comparison is that it doesn't pay a big upfront commission. Those annuities, especially the ones that we hear about, from those on the radio, certainly here in Chicago, that are selling these, the longer the annuity term, the bigger the commission. And it's not unheard of that the commissions are 8, 9, 10, 11%, whether it's the upfront commission or it's the soft dollars that come along with it. And so if you're looking for cash flow, if you're looking to hedge your portfolio, the banknotes are just absolutely one of the most prolific ways, in our opinion, to be able to do that. I mean, where else can you get an investment that's backed by, one of the best credit quality banks in the world? And all the banks, the big banks are doing them, JP, Citi, Bank of America, UBS, Morgan Stanley, et cetera, BNP, BBVA, Bank of Canada, BMO. They're all in, the space. It's just not a marketed, retail marketed space, but yet we talk about it on the radio. And I don't know if there's another radio show, certainly not here in Chicago. I think I know that just based on what I've listened to, but I can't tell you another radio show that I've heard of that actually talks about, the banknote strategy. And it just makes too much sense not to do it, especially when the minimums are now only $1,000. And when you hear, the Bank of England governor come out and say private credit is, worrying and echoes, the subprime mortgage crisis of '08, and you have UBS, that says that, recession probability is now at a staggering 93%. I mean, all of this is okay. I mean, this is investing. I mean, it's investing. Markets are going to go up. Markets are going to go down. I mean, that's just the reality of investing. 630-492-1912, 630-492-1912. And so that's okay if your portfolio is positioned to take advantage of that volatility or even make money in that volatility. And when you look at the bank notes, 12.5% is, the most recent one that we priced, almost 12.5%, 5 basis points short of that. Excuse me. There comes a level of comfort of when you have a portfolio that is constructed differently. And I think that's the job of an advisor. I was talking with our team this week, and, our job when we meet with investors because you don't know what you don't know. And most people are very educated in your field, but they're not educated necessarily in the investing world. You may understand investing, buy low, sell high. You may be able to articulate, when's a good time to get in, when's a good time to get out. But it's been my belief that, or my experience rather, that most people, they just buy and hold. And even worse, most advisors just buy and hold. So I think our job when we have an initial consultation, whether it's, Zoom or in person or a conference call, is to really give you an understanding of what the market for financial advice is. And then it comes down to you have to match what you're looking for with that type of an advisor. And, when we look at, the advisors that are out there, the bulk of advisors that are out there, no matter how it's marketed, no matter how it's packaged as so unique, so proprietary, so this, so that, the bulk of advisors that you're going to meet with are either A, selling annuities, B, are doing just a simple asset allocated model where you just have equities and you have fixed income. And they're then will, try to explain away why you lose money when the markets go down. And then they will lean on market averages, right? Where over 100 years and, the markets have done X. Well, nobody debates that the markets go up. They always go up. But my question to you is, wouldn't it be better to have something that could actually make money in a down market rather than actually just ride the market down? Because if you look at simple math, the less you lose, the less gains you have to actually get before you start compounding your assets, right? And that to me is, what we're going to really spend the remainder of the year talking about, and the remainder, certainly into 2026 because of where the market is. And I think I have an obligation. To call out, the bulk of advisors that, are just simply doing asset allocated models. And then when the markets drop 20 to 30%, which they will, we don't know when, but they will. They're just going to articulate to advisors, it's okay to lose money. So I'll give you an example of that here after the break. 630-492-1912, 630-492-1912.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC-registered investment advisory firm and fiduciary, headquartered in Oak Brook, right off of 22nd Street, right across the mall. Still can't get Google My Business to update our darn address, so it's still showing us as our Naperville address, but we are in Oak Brook, so feel free to stop in. We've put a lot of thought and really just a lot of planning into our office. So we love to welcome in people. I think it's very comforting, and I think you'll really enjoy, spending some time in the office and taking a look at, we're big sports memorabilia. Well, we're sports nuts, but memorabilia that we have, I think it's so interesting to kind of go down memory lane. And if you're any kind of a Chicago sports fan, from the 80s or 90s like I am, being 51 years old, you're certainly going to have enjoy some time in our office. So 630-492-1912, 630-492-1912. Again, the bank notes with 30% downside protection, we're still pricing around 12.5%. So you have 30% downside before you don't get paid your monthly coupon payment, interest payment. So you take your annual yield and divide that by 12. And as long as the indexes aren't down 30% from the day you issued it, you get paid your coupon payment, interest payment. So that's pretty strong, especially in this market. Banknotes are obviously really interesting, but also tax time. We have 2 months left to reduce your taxable income. Those are, I don't know if there's any other advisors out there that are combining the banknote strategy with the tax strategy, again, the Bison 2 Energy strategy, it is proprietary to us. We own it. So the tax benefits are massive, massive, massive. So if you've sold a business, sold a building, you have concentrated stock, you want to look at a Roth conversion while mitigating the taxable income. If you're a high wage earner, now is the time in the energy space, given oil prices being where they're at. We're investing simply alongside of the majors in the best oil field in the world, is our belief in the Permian Basin. So when you can invest in, as an owner, in the Exxon, Chevron, Conocos, Matadors, Mewbournes, those types of companies we consider to be the biggest and the best, and get significant tax benefits. Last year it was almost $90,000 per every $100,000. That's against active or passive income. 3 to 5 year exit certainly is something that you want to talk about. So we've got about 8 weeks, 10 weeks left of the year. So if you want to have that conversation, give us a call, 630-492-1912, 630-492-1912. So obviously, there's issues that are starting to form, in our opinion, in the market. Doesn't mean that they're going to be reflected. We're going to see big market crashes. But it's possible, and big market dips, but it is possible. And, we're on a mission to let you know that the bulk of advisors are not investing. It's our belief, at least, their personal money, their family money, in the way that they're advising clients. The way that most advisors will advise clients to invest is a way that they can scale their business easily. And generally that is just your typical buy and hold, and then they show you a chart of 100 years worth of market data. And I have to ask, well, what does that mean? If you're in your 50s, 60s, 70s, 80s, what does 100 years mean? If you bought Microsoft, and I love this statistic if you listen to the show, but if you bought Microsoft in 2000, it took you 14 years just to get back to even. So the markets can't stay sideways. They can't stay down for a longer period of time. And I'm on Twitter. Obviously, I love it. I think that's phenomenal. A couple of reasons. There's great content and great, talking points that we can share with individuals, that we can make sure that we're staying on the top of, kind of what everybody in the world is seeing. But I'm so tired of advisors that rely upon, just letting clients believe that they have to lose money, letting clients believe that it's okay to just put your money in an annuity that has a lifetime income component, and not sharing to you what inflation is going to do to that cash flow stream. That is something that really frustrates me, and that is something that we're very passionate about. If you want to work with an advisory firm that just does annuities and does asset allocated strategies, you don't need to work with them. Again, I told you we're in the Fidelity building, right? Right off 22nd Street. If that's how you want your money managed, go sit with them every quarter, let them manage your money. They don't charge you a fee. And then you just buy and hope. And if you have a significant time horizon, 15, 20, 30 years, okay, fine. If you're not worried about taxes, fine. If you're not worried about having strategies that can put up positive numbers in negative markets, okay, fine. Because far too many advisors are living in that space where that's their competition, is Fidelity. And there's no differentiation of what they're bringing to the table than what, a Fidelity or a Charles Schwab or a Vanguard is doing, in our opinion. And those are great companies. Those are really good companies. And it just comes down to a philosophy of managing money. And I saw a statistic this week that says if you want to explain to someone how investing builds wealth, show them this chart. Well, obviously you can't see the chart, but 10,000 invested in the S&P 10 years ago is worth $41,000 today. 10,000 invested 50 years ago is $4.2 million today. So you don't need to be perfect at timing. You just need time. That's 100% truth. In fact, that the longer you invest, the more money you're going to make. But the longer you invest, the more drawdowns of 20 to 30 to 40% that you're also going to experience. So if we look at time Does that mean that we shouldn't have strategies like the banknotes that as long as the markets aren't down 30%, that you can still make, double digits, offered by the biggest banks? Does that mean that we shouldn't have strategies like Bison 2, the energy strategy, that can greatly reduce your taxable income? Last year, almost 90,000 active or passive per 100,000 invested. And, the correlation or the returns of the market in the oil and gas space are not correlated heavily to the S&P. Does that mean that you shouldn't have a manager in like our growth? If we look at our pillars, our growth pillar, that historically since 95 has 1,000% cumulative outperformance of the S&P. Now, again, past performance is not indicative of future results. Anything we talk about on the tax side, because we can't give legal or tax advice, is truly for educational purposes only. The best practice is to always, talk with a professional in that space. But does that mean that, when you see these charts and you see that the longer you invest, that it goes up and to the right? Of course it's going to go up and to the right. I mean, that's just how it always has been done in history. 630-492-1912, 630-492-1912 if you want to have a conversation with us. But does that mean that you shouldn't have those other strategies in place? And, Charlie Munger, the late Charlie Munger, Warren Buffett's partner, the first rule of compounding is to never interrupt it unnecessarily. The first rule of compounding is to never interrupt it unnecessarily. You can take it a couple ways, but the way that I take that is, again, simple math. If you lose money, then you have to make a certain level of return just to get back to even. So why are advisors not talking about strategies inside of clients' portfolios that can protect and even make money on the downside? Why aren't advisors on the radio or advisors doing TV or advisors that are advertising, just however they advertise, or Wall Street for that matter, why aren't they talking about strategies like the bank notes that give you a 30% buffer of whatever indexes that note tracks, backed by the biggest banks, Bank of America, JP, Citi, UBS, et cetera? Why aren't they talking about those strategies more, that you have 30% buffer on the downside before you don't actually make money in a given month? Why aren't advisors talking about that? And again, it comes back to they're very labor intensive. It's so much easier to buy a bond, which bonds by the traditional advisor is supposed to be a risk mitigator. And I guess it's all dependent upon how we, define risk. But when you look at the bond market, just look at what the last 5 to 10 years have done. Look at the returns that you're getting in the bond market. Absolutely, my belief, in my opinion, pathetic. Absolutely pathetic when you compare them to the banknotes. I mean, if you look at AGG, which is the bond proxy, bond ETF, I haven't run the numbers in the last few weeks, but, the 10-year number, I think, on that is still, 1.5%. I think it's around 1.3, 1.4, 1.5 total return, reinvested dividends. So you're tying your money up for under 2%. And so that's what the traditional advisor is doing, because everybody is accustomed to, they don't really know what bonds are. They just know that bonds are safe. Well, of course, bonds are safe when interest rates, have gone down for the last 30 years and topped out in 85 at whatever it was, 15, 16% on the 10-year. So yeah, as interest rates go down, bond prices go up. I mean, that's just the way they work. But what if interest rates go up? What if inflation goes up? There's just a better way, in our opinion. And so we are that group that is willing to deal with, well, this is too good to be true, because we hear that all the time on the banknotes. Well, why doesn't everybody do it? Well, great question. Really great question, especially now the minimums are $1,000. And that's a great, great question. But advisors, again, you have to understand they're there to increase their ROI, their revenue. And so that's why they just do cookie cutter stuff. And that's our belief. And we're going to really uncover it. So 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. Happy October, almost coming up on November. My goodness, it's finally feeling like the weather is catching up to us. This week was a little bit of a shocker for some, given the coolness. We're big golfers, we're big sports fans, so it's been absolutely, it seems like, the group that we golf with, the last, 4 or 5 times we've been out in the last handful of weeks, it's like this is the best golf weather ever. And it's like we're saying that repeatedly, but it has been good. But it does get cold. So we like to do things that, are fun as well. And so we're, probably going to start hosting some events at some golf simulator places. Again, I'd rather not even talk business, right? I'd rather just, get a bunch of guys in a room and people in a room and go play a great course on a simulator. But we will give some education on, some of the uniqueness of strategies that we're bringing to the table, because not all advisors are created equal. Unfortunately, a lot of the buzzwords, a lot of the nice offices, a lot of, the CFP, MBA, CFA, SEMA, and you look at the decks that they're being shown and the reports. I mean, they make you, look really, really sophisticated, really, really unique and different. But, most advisors, unfortunately, are either A, selling annuities, the lifetime income annuities, we're going to talk about that this segment, or are just a buy and hold, strategy that is marketed as unique and proprietary and different. And unfortunately, it's not. So you're going to hear a lot more on that on the radio, because I think it's my job to articulate the types of advisors that are out there, and then you'll be able to gravitate towards one that you feel comfortable with, that is going to give you the best opportunity to make money in down markets, because that's really what it comes down to. So 630-492-1912, 630-492-1912. Now, our growth manager, again, past performance, not indicative of future results, but our growth manager that we utilize has destroyed the S&P 500 since 95. Absolutely destroyed it. Now, on an annual basis, not so much. 1.75% annualized. Doesn't seem like a big number, right? You do that since 95. I mean, that's 1,250% cumulative outperformance. So we want to get investors focused on 2 things. Number one, you have to ask your advisor, whoever you're working with, and if you're managing the money on your own, you have to ask yourself this, because you are the advisor. But what percentage of your portfolio will make money if the markets are down? Now, I say down, meaning negative 30. That's our buffer with our banknote strategy that we utilize. So we have 30% downside before we don't get paid on our monthly coupons. So you have to ask yourself, you have to ask the advisor, show me what bucket of my portfolio. I want to know. I want to know the investment. I want to know the characteristics. I want to give me the high level of what it is that's defined, because they have to be defined, because bonds can make money in a down market. Now, we're in the worst 5-year period, in the history of the bond market. You're tying your money up for a 10-year period of almost, 1.5%. I think that's foolish, but they could do well, but that's not defined. So if an advisor tells you that, well, we have this much in a bond, or we have this much in an annuity, and we're going to talk about the annuities this segment, that's not the answer. Like when a client would ask us, we would say, okay, we've got 25%, 30%, 50%, 80%, 10%, whatever that number is, in a banknote strategy that's offered by whatever the bank is, JP, Citi, Bank of America, Morgan Stanley, whoever the bank is. And we know that as long as these indexes don't go down 30% from the day we bought it, we're going to get paid our monthly interest payment. So whatever the annual rate is, right now they're still around 12.5%. As long as they don't go down 30%, we're going to get paid. So our clients actually know that. To me, that is a huge differentiator, because if the markets are up and our growth fund underperforms or outperforms by 2%, is that changing your life? Really? Seriously, is that changing your life? Now, again, our growth fund since 95 that we use, the manager that we use has outperformed by over 1,250%. So yes, if we have a significant length of time, you can beat the market, of course. But most people that we talk with are in their 50s, 60s, 70s, 80s. And a 2 to 3% outperformance, while it's nice, isn't going to change the world. It is nice, don't get me wrong, but it's not going to change, well, I shouldn't say the world, but it's not going to change your life. But what could change your life is if we do see cracks that are forming, especially in private credit. That is a big concern of ours right now, and we can go over it if you give us a call, 630-492-1912, 630-492-1912. If we do see the markets drop 20%, 30%, 15%, whatever, but yet we've got 25% of the portfolio, 50% of the portfolio, or whatever that percentage is that's making money, now that can change your life. Now that can help you sleep better at night. If we have a bucket of money that is in the energy strategy, that if you're blessed enough to be a high wage earner or want to do a Roth conversion while mitigating the taxes, or you sold a piece of property or you sold a business and you had a liquidity event and you have a big taxable income, you have 8 weeks left to try to reduce that. And we need to have a conversation, 630-492-1912, because we can reduce your active or passive income. Now, I'm not a tax professional. Anything we talk about on taxes is for educational purposes. Now, the tax benefits in the oil and gas and the energy space have been around forever. They're very black and white. Best practice, always reach out to whoever you get your tax advice from. But there is clearly a lot going on in the world today. And so we have to make sure that your portfolio is and has the ability to make money. It just burns me to see an advisory firm who manages 2, 3, 4, 500, 10 billion, 20 billion, whatever that number is, and charges 0.75%, 1%, 2%, whatever their fee is, and then just to articulate away losses. Now, they haven't had to do that recently, and they haven't. But they will again. Could be tomorrow, could be 10 years from now, who knows? But that bothers me. That bothers me that their revenue, there's a commercial out there that says, we do better as our clients do better. So as our clients make money, we make money because they charge a fee, right? But guess what? They still make money when the market or when the clients lose. So that adage of, we're on the same side of the table, blah, 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 to me, that's irrelevant. I mean, it's important, I guess, but what matters more is let's have a conversation about how we're not going to lose money. Let's have a conversation about how we can still make money if the markets are down. 630-492-1912, 630-492-1912. Okay, lifetime income annuities. Hot button. Hot button for us. The bank notes will cash flow double or triple what the annuities will. Double or triple. And most advisors that are selling them, certainly on this radio station, they're going to say, wait 5, 7, 10 years, right? Because you get 30%, 40% bonus, like it's free money, please. Who in the world gives you 30 to 40% of real dollars? Now, they may do it for income calculations, but real money. Oh, but it's going to grow at 7% a year. No, it's not. Absolutely, positively not. The 7% might grow or your income may grow at 7% a year, but not your real money, right? What is not talked about in the annuity space, the lifetime income annuity space, is how is that 5%, 6%, 4%, whatever that cash flow is, how is that going to keep up with inflation? Because if they're talking about lifetime income, which is what they are, what is that going to do with inflation? Because there are a couple annuities that there's a bunch of them that say, well, hypothetically, your income can go up. It'll never go up, ever, probably less than 1%. Again, the insurance companies, when you do a lifetime income annuity, you only are taking your own money out until that account goes to zero. Once the account goes to zero, then you're taking the insurance company's money. The insurance companies give you just enough growth, but they put a governor on your withdrawals. So how is inflation? What are you going to do with inflation? That's what's not talked about. And that is a really strong issue. So if you bought an annuity within the last 5 years, we have to talk because there's ways out, even if there's surrender charges. 630-492-1912, 630-492-1912. And that's what I get so frustrated about. Everyone talks about lifetime income. Okay, so what? There's tons of strategies that you can go and get income and cash flow. How does it affect inflation? And I think one consistent theme is inflation is going up. And if you want your purchasing power to be reduced by 60, 70, 80%, then go buy that. That's okay, right? As long as you know it. That's what you need to know. But when you have the bank notes that we're getting, 12%, 12.5%, 13%, whatever that note is, immediately each year with 30% downside. So we're actually making money while you're waiting to collect income. And when you do need income, you can get that same, whatever the note is at the time. Generally it's double digits with 30% downside backed by a bank. We can compare and contrast that all day. And so for those people out there that say we're annuity naysayers, couldn't be further from the truth. One of my favorite investments is our 5-year annuity, but it's a growth annuity. Has nothing to do with income. You get the first 10.75% currently of the S&P. That could change, but currently it's 10.75% with no downside. But it's only 5 years. So in our protected growth pillar, that could be a great option if you can accept up to 10.75% with no downside risk. So we're not against annuities. We just don't think that the lifetime income annuities are understood. And if we're looking at generating cash flow, in our opinion, significantly better ways to do it. So 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. Let's get through the commercials as quick as we can, right? We're SEC-registered investment advisory firm and fiduciary, headquartered in Oak Brook, so off of 22nd Street. So if you know where the Fidelity office is, we're in the same building. We're on the 5th floor, Suite 530. They're on the 1st floor. Stop in. We'd love to see you. Absolutely stop in. You just may have to wait if we're in a meeting. But if you've got some time, come on in and we can talk what we're doing, and we would love to do that. So 630-492-1912, 630-492-1912. Markets, we've talked a lot, obviously, this week, but I think our job, I was telling the team this week, is really getting clients to understand the types of advisors that are out there. If you want buy and hold, if you want more of the same, if you want to track the market up and down, if you want to be, told that if the markets are down, don't worry, it's going to come back. And, it may take 3, 5, 7, 10 years, but it's going to come back, or the markets are never going to go down, blah, blah, blah. Then there are so many advisors that you can find, millions of advisors that will subscribe to that theory. Our theory is different. Our theory is, let's craft a institutional financial plan. Let's craft a allocation of the portfolio that can still make money with the bank notes as long as the markets aren't down 30%. We use 30%. We could do one that's 20%, 40%, whatever. Now that'll affect the rate, but 30 is something that we're very, very comfortable with just based on all the math that's offered by the largest banks, JP, Citi, Bank of America, Morgan Stanley, Goldman, et cetera. So let's have that in a portfolio. Let's have a bucket of the portfolio that can greatly reduce your taxable income. Last year was almost $90,000 per $100,000 invested in our Bison 2 Energy Fund. That's active or passive income. So again, 12/31's coming up. If you make a bunch of money, you have big capital gains this year, from a sale of a business or property, or you want to do a Roth conversion. Let's talk about how we can offset, some of those taxes by investing in the energy fund. If you want a strategy that is a hedge fund strategy that is event driven, that is, can go long, can go short the market, that is, maximum flexibility. It's our kind of our, we call it our growth plus bucket. So 5, 10, 15%, 20% of someone's money that can really follow themes. And that's what the market is today, truly. I mean, just look at Beyond Meat, this week and look at what that did. Just pull a chart up of that. There are themes that, people and institutions get behind. So if you want to learn more about the Bison Alpha strategy, again, that's something we can share with you. And then obviously the growth bucket, it has historically, albeit past performance is not indicative of future results. It has historically significantly outperformed the S&P 500. So you craft a portfolio of what we are doing. So the institutional financial plan, maximum, our protected growth pillar, which is, the banknotes, and the 5-year principal protection strategy, the growth pillar, which is, our individual stock portfolio, which I can never imagine why you would work with an advisor to just pick index funds or mutual funds. I just don't understand. Please call me. Let's have that conversation. 630-492-1912. Talk to somebody from my team on what you're doing is really just making the advisor rich. If that's how you want your money managed, just simply, go to Schwab, go to Fidelity, go to a firm that, is kind of a do-it-yourselfer that has advice and advisors that you can meet with periodically. I would never pay an advisor for that type of management, but so much of that is out there. And, that, again, that 1 to 1.5% fee, man, that adds up over time. And then our Bison Alpha Hedge Fund, which is, our opportunistic, growth pillar. And then we've got obviously the tax reduction strategy, which I think is, totally unique. And, because if you remove the Mag 7, if you remove the Mag 7 from the S&P and the earnings of the S&P, it looks very, very different. Very, very different. And now, again, gains are gains. We've always said that. Gains are gains, right? However you get them, how you get them, whether they make sense or not. A joke that we have within our team is, do you want to be right or do you want to make money? Do you want to be right or do you want to make money? It's like the down market, right? The markets are down. Advisors explain away. This is where they become on defense, right? Because they weren't forward thinking enough to put you in a strategy that would take some explanation, that is an institutional strategy, that is a family office strategy like the banknotes, and talk about how this can actually deliver positive returns in negative markets to a point. Negative 30 is our point. They would rather just explain why they were wrong, or right, rather, for being wrong, because they lost money. And don't worry, it's going to come back. Or do you want to work with an advisor that says, we know the market's going down at some point, maybe tomorrow, maybe 20 years from now, but it's going down at some point. And for your safe money, if you're going to take, if you're comfortable with a double-digit return, maybe it's not the 50%, 80%, 100%, whatever that the Mag 7 is producing, but for our safe money, if you're happy with double digits, knowing the parameters before you invest, the parameters, the outcomes, everything. There's very few investments that you actually can say that about. But if that's what you want, well then, boom, we're going to give it to you. Because the markets can go down. They can go down. October 19th, 1987, Black Monday, right? Here, markets are down 20% that day. 20% that day, the S&P. Now, the world has changed. I don't know if we could experience that today, but I didn't think we could have a subprime crisis in mortgages. I didn't think that we'd have COVID. That's one consistent in this industry that I'm like, well, nobody saw that on your bingo card. Well, you never do. And those that do probably don't see it, consistently. They just get lucky once or twice. Now they raise a bunch of money on that call. I can't tell you how many people have raised billions because they were right one time. And that's good for them. Really good for them. But yet October 19th, 87, it was down 20%. October 28th, 29, it was down 12%. Then 2020, March 16th, it was down 12%. March 12th, 2020, it was down 9.5%. October 15th, 2008, it was down 9% in a single day, right? A single day. So can it happen? I don't know. Maybe. I don't know. Nobody knows. And those that tell you they do know, they're the ones that know the least, because they're not willing to even share what they don't know. And our answer to that is, well, we don't know. So what we want to do is put strategies in a portfolio that can actually benefit from when that happens. Actually benefit if we see big dips. Benefit as long as the indexes and the banknotes aren't down 30%. You still make double digits, or whatever that no price is at. Oh, offered by the biggest banks, right? Those are the things that I think an advisor needs to bring to the table. Those are the things that advisors need to bring to the table, especially in a market like we're in today. Margin debt is rising at a rate last seen, before, generally big bear markets and market crashes. Again, doesn't mean it's going to happen this time, but we have to look at similarities. Margin debt jumped significantly, almost 6.5% to $70 billion in September. To a record $1.13 trillion. That is a lot. That is a lot. Investor speculation has surged significantly since April, almost 40%. That is the biggest 5-month spike since 2021 in that market frenzy. So we have to look at the reality of things. And in the past, similar margin debt spikes have almost always preceded major market declines. .com, great financial crisis, 2018, the late Fed-driven sell-off, 2022 bear market. So the question is, will history repeat itself? And the answer is, I don't know. The answer is nobody knows. The S&P 500 is trading at over almost 3.5% times sales, highest valuation in its history. Now, all of these things are just talking points. The markets can become much, 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 much more expensive. The old adage is the markets can stay, sane or crazy longer than you can stay liquid. That was, goodness, we said that over and over again when I started in the industry in the late 90s. So the facts are that it's going to come again. Could be tomorrow, could be 20 years from now. The effect that it'll have on you is where you're at in your investing life. If you still have 10, 15, 20 years where you can put money away, or are you nearing retirement, or are you in retirement where cash flow or buying the dips, you're limited, and then it's going to have a great effect on you. And so my job at our firm and what we're articulating to my team is forget selling banknotes, albeit they're great. Forget talking about Bison 2 and the energy strategy and how it can reduce your taxable income. Forget talking about Bison Alpha and the hedge fund and all those positive characteristics. Let's get to the heart of explaining to investors the types of advisors and what they're offering and the pros and cons of each type of an advisor. And then let's let the investor decide who they want to work with. You want to work with, in my opinion, somebody that gives you more outs. What are more outs when it comes to investing? Ways to either A, make money in a negative market, B, not lose money in a negative market, or lose less. Because again, it's just simple math that if those are less gains that you have to get to make up before you're actually compounding your money again. And as Charlie Munger said, the first rule of compounding is to never interrupt it unnecessarily. And my fear is many advisors are crafting portfolios for investors that investors think they have it so unique, so proprietary, so risk managed, but it will get interrupted if and when the markets go down. And then the advisor sits there and says, don't worry, it'll come back. That should be good enough for you. 630-492-1912, 630-492-1912. Let's meet this week, next week, when you're ready. Thanks again. We'll be back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.